Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the market today in a clear and simple way. So, um, back in late May of 2026, a South Korean government server literally melted down.
Right. Yeah, it completely collapsed.
And, it wasn't a cyber attack or like a random software glitch. It crashed because thousands of everyday people were frantically trying to log in at the same time to take this mandatory online risk education test.
Which is just a wild visual.
It really is. And they were doing this just so they could get legal clearance to buy these highly volatile, triple leveraged ETFs tied to U.S. tech stocks.
Yeah, and I think that specific event, it perfectly captures the extreme market dynamics we're looking at in this deep dive today. Because, when you look at your brokerage account and see these massive, inexplicable daily swings in major U.S. tech and AI stocks, well, you probably assume it's just Wall Street hedge funds running algorithms, right?
Exactly. I mean, that's what most of us beginner investors think. We just assume the big guys in New York are moving the needle.
Right, but according to the data we have from early 2026, that assumption is missing a massive piece of the puzzle. The volatility isn't just coming from institutions. A shocking amount of it is actually being heavily influenced by everyday retail investors all the way over in South Korea.
Wait, really? Just everyday people over there?
Yeah, exactly. Though, to set the baseline here, we do need to clarify a common exaggeration because there are rumors out there that foreign investors are just entirely running the U.S. single stock leveraged ETF market.
Right, I've seen some of those headlines.
Yeah, but recent analysis from Reuters in February 2026 confirms that's just not true. That specific market, which by the way has exploded to roughly 355 different funds, it's still 90% driven by U.S. retail investors. So the home crowd is definitely still the foundation.
Okay, that makes sense. But the margins are where the really violent price action happens.
Yeah,
Because looking at the data, South Korean individuals have become the absolute dominant foreign force in this space. I mean, they aren't just parking their money in broad passive index funds like the S&P 500 like you'd normally expect.
No, not at all.
They've carved out this massive, highly specific niche. They are specifically targeting 3 times leveraged tech and semiconductor funds. It's like if buying a regular tech stock is like ordering a mildly spicy dish at a restaurant, buying a 3x leveraged ETF is like chugging a bottle of pure ghost pepper hot sauce.
That is a perfect analogy. And, the scale of this capital migration, it's difficult to wrap your head around without looking at the specific numbers.
Hit me with the numbers. How big are we talking?
Well, by the end of 2025, Korean retail investors held a staggering $42.17 billion in U.S. ETFs.
Wow, 42 billion.
Yeah. And the growth in the leverage sector is the real story here. Take TQQQ, for example. It's a fund that tracks the NASDAQ index, but mechanically triples the daily returns.
Okay, so it goes up 3 times as fast, but also drops 3 times as fast.
Exactly. Korean retail investment in that single fund jumped from $1.33 billion in 2021 to $3.42 billion in 2025.
That is a massive jump. But from what I'm seeing, even that pales in comparison to what they're doing in the semiconductor space.
Right, well, absolutely.
Because there is this fund called SOXL, which is a 3 times leveraged semiconductor fund. And the data shows Korean retail investment in SOXL exploded from $427 million to over $3 billion in that exact same time frame.
Right, which is just an incredible increase.
I mean, that's a 7-fold jump.
Uh-huh.
And looking at April 2026 data from NTFGI, the trend is only accelerating. Like out of the $7.31 billion of top foreign ETFs purchased by Koreans in just that period, 12 of the top 22 were leveraged or inverse products.
And SOXL was sitting right firmly at the top of that list, right?
Exactly. But I have to act as the voice of the beginner U.S. investor here and just ask, wait, why? Why take on that extreme risk? Why not just buy regular NVIDIA or Apple stock, and just sleep peacefully at night?
That is the fundamental question here. Because remember, leverage is essentially just borrowed money. So why are they using this specific dangerous instrument?
Yeah, what's driving it?
Well, recent analysis indicates it is a highly calculated response to their domestic economic environment. It's not just blind speculation or gambling.
Oh, okay, so it's tied to what's happening in their home country.
Exactly. To really understand this, we have to look at the historical performance of their home turf. The South Korean domestic stock market, which is called the KOSPI, has historically been characterized by these long, really frustrating periods of stagnation.
Right, so it just wasn't growing.
Exactly. It would trade sideways for years, so it offered very little organic growth for the average worker who's just, trying to build a retirement portfolio.
That sounds incredibly frustrating.
It is. And when you pair that stagnant domestic market with an incredibly high cost of living, particularly the real estate market in major cities like Seoul,
Oh, right, I've heard Seoul housing is astronomically expensive.
unbelievably expensive. It has become largely unattainable for the average earner. So traditional savings accounts and basic domestic index funds, they simply don't offer the mathematical returns required to actually achieve upward mobility anymore.
Ah, I see. So leverage basically becomes the structural workaround.
Precisely.
It's like, think about like baseball. When just hitting singles and doubles isn't mathematically enough to win the game anymore, investors feel forced to swing for the fences on every single pitch, even if it means they might strike out completely.
That's exactly it. The underlying asset might only move a little bit, but because you are using borrowed money, your personal equity is either going to double or get completely wiped out. They are using leverage as a shortcut because the traditional avenues of wealth creation feel permanently blocked off to them.
That makes a lot of sense, sadly. But why specifically U.S. tech?
Well, that structural need for a shortcut is compounded by this deep-seated cultural confidence in the U.S. technology sector.
Even with all the political changes. I mean, currently we've got the Trump administration handling global trade dynamics, which can be pretty unpredictable.
Even with that, yes. Despite shifting geopolitical landscapes or trade policies under the current Trump administration, these investors view U.S. big tech as just this unstoppable engine of global growth.
Like it's totally immune to normal cycles.
Right. They see it as an asset class that transcends normal market fluctuations. And add to that the fact that South Koreans are highly familiar with the semiconductor industry specifically.
Oh, right, because companies like Samsung and SK Hynix are basically the pillars of their domestic economy.
Exactly. When a Korean investor looks at a U.S. semiconductor fund like SOXL, they aren't looking at some abstract, confusing foreign concept.
They intimately understand it. They know the supply chains, the AI cycle, the memory chip demand, because their own national economy is built right on top of it.
Yeah, it feels like a home field advantage to them, just played on an international exchange.
That makes sense. But I imagine that familiarity creates a really dangerous level of comfort with extreme risk.
It absolutely does. And, the narrative gets significantly darker when we look at how this strategy has mutated over the last year.
Mutated how?
Well, this appetite for high-risk, debt-fueled investing hasn't stayed neatly contained in the U.S. market. The data shows this violent contagion effect spilling directly back into South Korea's domestic market.
Oh, wow. So the investors who developed a taste for 3 times leverage trading U.S. tech basically brought that same aggressive playbook back home to the KOSPI.
Exactly. And the timing here is critical because that historically stagnant KOSPI suddenly woke up.
Right, driven by the global AI boom.
Yeah.
The domestic index surged 76% in 2025 and then an astonishing 83% in 2026.
And that was overwhelmingly led by their own semiconductor giants, Samsung and SK Hynix.
I mean, 83% in a single year for a major national index, that is a historic anomaly.
It is. But what is truly fascinating here is the underlying flow of funds. Because according to Reuters, in 2026, Korean retail investors poured 79 trillion won, which is roughly $51.8 billion into the KOSPI.
That is a staggering amount of retail cash.
It is. But here's the catch. During that exact same period, foreign institutional investors were looking at global macroeconomic indicators and deciding to de-risk. So the institutions actually executed a massive 124 trillion won sell-off.
Okay, let's just pause and look at the mechanics of that for a second. Normally, when major global institutions dump 124 trillion won worth of stock, the market craters, right?
Right, the price usually collapses under the sheer weight of the sell orders.
But in this case, the domestic retail crowd acted like a giant financial sponge. They absorbed the entirety of that institutional dumping, bought the shares, and somehow still managed to push the total market value up by 83%.
Yes. But the really scary part is how they paid for it.
Right, they didn't just use excess cash sitting in standard savings accounts, did they?
No, they didn't. The systemic fragility here is that the global institutions took real cash out of the Korean system, and the retail investors replaced that cash with debt.
Oh, boy.
Yeah. By June 10th, 2026, margin debt, which is, money borrowed directly from brokerages to buy more stock, hit 29 trillion won. That represents a 71% increase from late 2025.
That is terrifying.
Yeah.
The total leveraged stock investing hit a record 60 trillion won, or about $39 billion. It literally reached a point of systemic exhaustion.
Yes. Brokerages actually hit their strict regulatory lending limits. Retail investors literally could not borrow another dime from the major brokers because the entire financial system was just completely maxed out on margin.
Which perfectly explains why that government server crashed in late May of 2026.
Exactly.
When the traditional brokerages cut off the margin loans, the South Korean market introduced its first single-stock leveraged ETF for Samsung and SK Hynix.
Right, which allowed investors to get double the daily leverage without technically taking out a margin loan from their broker.
So that crazy rush to take the mandatory risk education course, that was simply the retail crowd desperately hunting for a new source of leverage after they had completely tapped out the existing system.
You nailed it. And that level of systemic leverage, it really requires us to look closely at the actual mathematics of these funds.
Yeah, because a lot of beginner investors might not understand how they actually work behind the scenes.
Exactly. Many investors look at a 3x leveraged ETF and think, okay, if the underlying stock goes up 10% over the year, my fund goes up 30%, and if it goes down 10%, I lose 30%.
Right. It sounds like simple multiplication.
But that fundamentally misunderstands the mechanical trap of these specific instruments. We need to dissect the concept of volatility drag.
Volatility drag. Okay, break that down for us.
The defining characteristic of a leveraged ETF is that it tracks daily returns. It resets every single time the closing bell rings.
Okay, so it starts fresh every morning.
Right. And because of that daily reset, the mathematical path the stock takes to get to its final price matters much, much more than the actual direction it eventually goes.
Ah, okay. Let's look at how this mathematically functions with just a standard, non-leveraged investment first, to make it simple.
Good idea.
So if you start with $100 and the market drops 10% on Monday, you now have $90.
Right.
To get back to your original $100 on Tuesday, you don't just need a 10% gain. 10% of your new $90 baseline is only $9, so you actually need an 11.1% gain just to break even and get back to zero.
Exactly. A loss inherently requires a mathematically larger percentage gain to recover. Now take that mathematical friction and multiply it by 3, resetting every 24 hours.
Oh man, that sounds brutal.
It is. Imagine an underlying index that is highly volatile. It jumps up 5% on Monday, crashes 5% on Tuesday, rallies 6% on Wednesday, and drops 6% on Thursday.
Okay, just bouncing all over the place.
Right. If that underlying index ends the year completely flat, meaning it's trading at the exact same price it was on January 1st, a 3x leveraged ETF tracking that index will not be flat.
Let me guess, it's down.
It will have lost a massive percentage of its value. The daily compounding of those amplified losses acts like a structural termite, just eating away at the capital from the inside out.
Wow. And this isn't just a theoretical whiteboard exercise either. MarketWatch data highlighted a recent trading session where the Korean market swung almost 16% in just 24 hours.
Which is incredibly violent.
Right. When you apply triple leverage to a market vibrating with that much kinetic energy, the volatility drag becomes catastrophic.
And it gets worse. There is a secondary mechanical flaw in these funds that actually creates even more market chaos.
Wait, worse than the structural termites?
Yeah, because to maintain that exact 3x daily leverage ratio, the fund managers are forced to rebalance their books at the end of every single trading day.
Okay, let's break down exactly how that end-of-day rebalancing works, because it honestly defies traditional investing logic.
It really does.
So let's say a 3x ETF have $100 million in assets, meaning it needs $300 million in total market exposure.
Right, to keep the 3 times ratio.
Right. If the market goes up strongly that day, the fund's assets grow, let's say to $110 million. To maintain that 3x ratio for tomorrow, they now need $330 million in exposure.
Yes.
So right before the closing bell, the fund must mechanically buy $30 million more of the underlying stock.
Exactly. They are literally forced to buy more shares precisely when the price is at its highest for the day.
That is the exact opposite of buy low, sell high.
It is. And the inverse is true on a red day. If the market tanks, the fund's asset base shrinks, and it suddenly has way too much market exposure relative to its new, smaller size.
So the managers are mechanically forced to dump shares into the closing bell, selling into weakness.
Exactly.
So by design, you have billions of dollars in these leveraged funds that are systematically forced to buy high and sell low at 3:59 p.m. every single day.
Every single day. And when the market is volatile, these massive rebalancing orders act like a giant fan blowing on a fire. They amplify the price swings and generate even more chaos for the next trading session.
That is wild. Which I guess leads us directly to the systemic risk facing the broader market.
Hmm.
Because the U.S. tech market and the South Korean retail market, they are no longer isolated systems.
Not at all. In 2026, these international retail investors have effectively become high beta liquidity providers for the U.S. market.
High beta liquidity providers, meaning they are this massive aggressive pool of capital that injects billions into the market during the good times, driving prices higher.
Right.
But that capital is structurally unstable. It is entirely built on margin debt and daily resetting leverage.
That is exactly the issue. By heavily concentrating their portfolios into U.S. tech stocks, U.S. leveraged tech ETFs, and domestic Korean AI stocks all simultaneously, they are functioning as a global echo chamber.
So they're basically importing U.S. volatility into their own economy, amplifying it with margin, and creating a massive feedback loop.
Yes. And we saw the mechanical reality of this exact feedback loop in early June 2026.
Right. When the U.S. tech sector experienced just a standard wobble, it was just some routine macroeconomic jitters regarding Federal Reserve interest rate policy.
Yeah, nothing catastrophic, just a normal market pullback that happens all the time.
But look at what happened across the Pacific. Because the South Korean retail sector was so heavily leveraged into U.S. tech, that minor U.S. pullback triggered a wave of margin calls in their American brokerage accounts.
And for anyone who doesn't know, when a broker issues a margin call, the investor has to deposit more cash immediately, or the broker will forcefully liquidate their assets to cover the debt.
Exactly. So to cover those U.S. losses, the Korean investors had to quickly raise cash by selling the only other liquid assets they had, their domestic stocks.
Right, so a minor hiccup in New York triggered forced, panicked selling in Seoul.
The U.S. wobble crashed directly onto the shores of the KOSPI the very next morning, dragging the entire Korean index down, which in turn triggers more domestic margin calls over there.
It is a perfect cascade of falling dominoes, all connected by debt. And this cascade exposes the ultimate danger facing investors today: the illusion of diversification.
The illusion of diversification. I love that phrasing because to understand the false security of this illusion, think of building a portfolio like ordering a meal at a restaurant.
Okay, let's hear it.
You sit down wanting a balanced diet, right? So you order mashed potatoes, a side of French fries, and a loaded baked potato.
Sounds delicious, but terrible for you.
Exactly. When the plates arrive, you look down and wonder why you don't have any protein or green vegetables. You ordered 3 different dishes, but you fundamentally ordered the exact same underlying ingredient, just processed differently.
It is a plate entirely made of potatoes.
Exactly. And when we look at the brokerage accounts of these highly leveraged investors, we see the exact same mistake being made.
We really do. They buy regular NVIDIA stock, thinking that serves as their stable blue chip anchor.
Right. Then they buy the SOXL leveraged ETF, looking for aggressive growth.
Right. And then, to quote-unquote diversify internationally, they buy a domestic Korean semiconductor ETF tracking Samsung and SK Hynix.
They look at 3 different ticker symbols and assume they have a diversified portfolio.
Yeah.
But they don't. It is all mashed potatoes.
It really is. They have simply made the exact same bet on the global AI and semiconductor cycle in 3 different fonts.
Yep.
They are exposed to the same supply chain bottlenecks, the same macroeconomic interest rate sensitivities, and the same consumer demand cycles. If that specific sector experiences a sustained downturn, every single one of those assets will crash simultaneously.
And because so much of that capital is heavily leveraged, the crash won't be a slow deflation. It will be a violent, forced liquidation. The vital takeaway from the data we've explored today is that leverage is never a magical tool that just mathematically boosts your returns.
Absolutely not. It is, first and foremost, a risk amplifier. Global markets are now so deeply interconnected that extreme retail leverage in one hemisphere acts as unstable rocket fuel for the other.
It pushes U.S. tech stocks higher during a bull rally, for sure.
It does. But when the inevitable dip occurs, that invisible web of margin debt triggers forced sell-offs that ripple across global exchanges.
Well,
When you buy a popular tech stock today, you are no longer just investing in the underlying company's balance sheet or its future earnings potential.
no, you are intimately investing in the financial stability of the unknown, highly leveraged people holding that exact same stock right alongside you. You are betting that when the market drops 5%, the guy holding the same stock doesn't get a margin call from his broker that forces him to liquidate his position at market price, driving the value of your shares down with his.
Exactly. It's a chain reaction.
So as we wrap up this analysis, let's turn the focus back to your own brokerage account. Look past the variety of ticker symbols and the different fund names you hold. Are you genuinely diversified across entirely different asset classes, sectors, and risk profiles? Or have you unknowingly built a portfolio of mashed potatoes, secretly holding 3 different versions of the exact same AI bet, just waiting for a global ripple of margin calls to tip over the dominoes? It is the most important question you can ask yourself in today's market. Don't forget to subscribe and hit that like button.